Hello and welcome to the Global View on this Friday morning. It's nice to be here with you. I'm Nadine Blaney. So last night, the benchmark S&P 500 and Dow Jones Industrial Average ended flat. The Nasdaq, as you can see, slightly higher. If you recall, all three indexes had posted their biggest single-day percentage drops in a month in the previous session, so Wednesday. Last night in stock specifics, Nike shares rose on plans to rejoin the Amazon platform and hike some prices. Xerox shares crashed in extended trade after it cut its quarterly dividend in anticipation of the closing of a big transaction, though it did reiterate its full-year forecast. Intuit was up close to 6% in extended trading as well on a robust quarterly forecast. But Ross Stores, which is a discount retailer, was hit after it withdrew its annual forecasts due to tariff worries. And NextEra Energy shares fell on expectations that U.S. President Donald Trump's tax and spending bill could end many green energy subsidies that have driven the renewables sector higher. Meantime, U.S. crypto firms rose after Bitcoin reset a record high. That includes Coinbase, which was up close to 5%. Bitcoin, here you go, up around $111,000. Likely to impact trade here today, we saw gold miners falling as the gold price slipped on the stronger U.S. dollar, and oil stocks fell on a report that OPEC Plus is discussing further output hikes come June. Now, that so-called Big Beautiful Bill, which is a sweeping tax and spending bill, has passed the U.S. House of Reps. Now, the bill passed by a single vote margin. It will deliver new tax breaks on tips, for example, and car loans, as well as boosting spending on the military and border enforcement. It will add about $3.8 trillion to the federal government's debt over the next decade, according to the U.S. Budget Office. Now, in economic news, jobless claims fell. U.S. business activity improved in May as the U.S. called a truce with China over trade. However, the PMI is indicating inflation is poised to accelerate. Manufacturing delivery delays were the longest in 31 months, while exports of services, including spending by foreign visitors in the United States, dropped at the sharpest pace since the COVID-19 lockdowns. And U.S. existing home sales unexpectedly fell in April. Meantime, in Europe, the PMI unexpectedly dropped, falling below 50. Services were particularly weak, although the German IFO index rose in May. RBA Deputy Governor Andrew Hauser spoke about the Australia-China economic relationship, saying his business contacts in China see opportunities for Australia amidst the U.S.-China trade rift. All of that saw the U.S. 10-year yield falling from 4.6 to 4.54%. Markets are pricing in a 0% chance the Fed funds rate will be cut by 25 basis points at the next meeting in June. We heard from FOMC member Waller, who said that the central bank could cut interest rates in the second half of 2025 if tariffs settle lower. Now, the U.S. dollar lifted modestly, putting slight pressure on the Aussie dollar, although it is up around 64.1 versus the U.S. right now. Oil prices at a 4-year low. There are reports, as I mentioned, that 8 OPEC Plus countries, which are meeting on the weekend, are poised to further speed up an oil output hike come June. Brent crude futures fell 1%. Copper rose 1%. Iron ore fell to $100 per wet metric ton, and gold fell 0.7%. So to digest all of that, I caught up with Peter Cardillo from Spartan Capital in New York just a short time ago.
Well, basically what the bond market is saying to Washington, we don't like this bill, and we think it's going to be not good for the economy, and certainly going to raise the deficits. And so the other day we lost steam because yields moved up, and of course today they moved back a little bit down. And I think, now that it's passed Congress, it's going to be sent to the Senate, and I'm sure that they probably will pick at it and maybe send it back and forth until they get an agreement that might be pleasing to the markets. But under its present form, the bond market doesn't like it. And if the bond market doesn't like it, the stock market is not going to like it.
No. And so we saw a pretty flat finish for the markets there. When you think about what that's telling us, is it telling us that, even equity investors are becoming increasingly nervous about the state of the US's balance sheet?
Of course, there's no question about that. The bond market is telling us that. And, there are other affairs out there, the trade war, and the fact that we continue to see mixed readings on the macro indicators, which some indicate that perhaps the economy is already in recession. So there's a lot of fear factor out there. And this budget and tax cut is not pleasing to the bond market. And so I'm a great believer that the markets generally dictate to the lawmakers what they need to do. So this might be the wake-up call that the bond market is flashing to Washington.
Well, we will see, because, of course, that bill still does have to pass the Senate, Republican controlled, but just. So when you look across asset classes, Peter, we saw gold come off overnight, and oil. Oil is just having a terrible time. We're looking toward potential output hikes coming from OPEC Plus over the weekend. So what else? What other asset classes are you looking to for opportunity?
Well, right now, I think the asset class since the beginning of the year and prior to the beginning of the year has been gold. I'm not too concerned that it came off. I think it's in a good position right now to probably reach new 52 weeks highs. One of the reasons I say that is if you look what happened to gold the other day when interest rates were skyrocketing, when yields were skyrocketing, and the dollar was coming under pressure. Usually, when that happens, there are strong headwinds for the price of gold. It usually moves the opposite way, but it didn't. It went up instead of down. And I think the reason for that is that the dollar is likely to weaken. At the G7 meeting, I would think that, the United States is going to once again say we want a weaker dollar. And that would mean that gold prices would take off again. So the fact that gold is doing what it's doing, okay, yeah, so you have one day up and maybe you have a day or two that's down and you have a strong up day. That's really what's constructing the next move to new highs. So I'm not really worried about that. In terms of oil, we have the OPEC meeting. We know they're going to raise production. The question is by how much? And I think that's what the market is fearing. And it does look like perhaps the Iranian-U.S. Nuclear deal seems to be fading. And that's one more reason to think that there'll be a cushion for oil prices, but not around the $60 level, more so around the 55. And the reason for that is over an imbalance of supply and demand, and of course a demand factor in terms of usage.
Right. So if we look at what could influence markets going forward in a meaningful way, you've got to look to the Fed. Now, the market is pricing in a 0% chance of a cut coming at its next meeting. But we heard from, for example, one of the FOMC members, Waller, overnight. He was saying that, if there is a reasonable deal done between the US and China, I think he put it at around 10%, then it looks as if the Fed will be able to cut later in the year. So What kind of an impact do you reckon that will have? Because in one way, it's a recognition of, economic headwinds, but on the other hand, it would be bringing rates away from restrictive territory further.
Yeah, yeah, I'm in accordance that they're probably all going to get one rate cut, and that's probably going to come in the latter part of the year. Now, the reason for that is even if we get a China deal, or we get any deal, you're still looking at a floor of 10% tariff, which means it's probably going to add to inflation. So the Fed is in no hurry to lower rates unless they really need to. That is, if the economy falls off a cliff. And even then, it would be quite dangerous because you'd be in a situation where you'd have stagflation and an economy that's in a negative growth. That's would be a horrible situation. So the Fed is sort of caught in a box here. And I think that they're going to take their sweet time. They're going to make sure that whatever inflation emerges from the tariffs, that it is controllable. And more importantly, that it's temporary. So if you look at some of the recent inflation data, referring to the PPI and the CPI, there was no hints that tariff inflation has sprung up, and so it's brings us back to that timetable, that time waiting table, that the Fed needs to be cautious and write it out and see what happens.
So that sets us up for the day's trade here in Australia. SPY futures are pointing to a 22-point lift at the open, so going our own way after that flat finish. In New York, I had a chat with Scott Phillips from the Motley Fool, who said it might be a bit of a halo effect impacting our local market in the wake of that interest rate cut earlier in the week. I'll bring you that interview after the break.